Well, hello everyone, and thank you for being here with me today for our presentation on taking advantage of your TSP early in your career. My name is Monica Zamfir. I am one of the financial planners on staff with GIBA, and today we will be covering a lot of information on federal retirement benefits, the Thrift Savings Plan, TSP contributions, investment options, the importance of a long-term investment strategy, market updates, and at the end, we'll also go over a brief overview of workforce reduction methods, just given the current climate. So I'll go ahead and get started. I wish I could allow for more time for more to join us, but again, it is a long presentation. um, so here we go. Now, preparing for retirement is a complex process as everyone's situation is different. And while this presentation strives to answer many of the questions you may have by touching on the most important aspects, 1 hour is hardly enough. It's really only enough to give you a 10,000-foot view of the topic. Now, following the presentation, we will be sending out copies of the slides to all of you. At the end of the webinar, there will be a survey which will give you the opportunity to ask specific questions, which myself and my colleagues will follow up on to answer for you. Throughout the seminar, you can also ask questions in the chat. Now, time permitting, I may be able to answer some, but if I don't get the chance to, post-presentation, we will compile a list of questions, answer them, and send it out to all of you. If you'd like further details or assistance with your individual situation, please don't hesitate to reach out to Giba. Our contact information is toward the end of the slide deck, or you can request during the survey for us to reach out to you, and we'll be more than happy to. Now, a little bit about myself. As I mentioned, I am one of the financial advisors here at GIBA. I'm a certified financial planning professional and a chartered federal employee benefit consultant. That's a mouthful. I have been in the industry for over 17 years, helping individuals and families just like yours plan for retirement or any other financial goals. Now, for those who may not be familiar with GIBA, we are a not-for-profit membership association that was established by NSA employees in 1957. We work exclusively with federal employees and their families. We were originally created to provide benefits that were not available to the federal government at the time. So back then, things like dental and vision insurance were just not part of the benefits offering the federal government had. Now, over time, as the needs of our members evolved, we expanded to offering other types of services such as financial planning, investment management, in addition to a vast array of insurance benefits, some specifically tailored for federal employees. And you'll actually find a comprehensive list of benefits and services available at the end of this deck. Now, all of our financial advisors are fiduciaries, meaning we always place member interest first and foremost. All of us are salaried. We're not compensated on commission. And any recommendations we make are a result of objective analysis and what we believe to be suitable for someone's financial goals. All right, so brief overview of the seminar topics, as I mentioned in the introduction. So let's go ahead and get started. Now, whenever I start planning for retirement with my clients, the first question I have is, what does retirement look like to you? And this is your opportunity to really think about what you want to do when you're retired, apart from not work anymore. After spending 20, 30, 40 years serving your country, this is your time to see the world, road trip across the US, spend more time with family and friends, go fishing, enjoy hobbies you've never had time for, maybe do volunteer work, whatever it is, that will bring you fulfillment in retirement. Now, this is an opportunity for you and your loved ones to articulate your vision of retirement and craft your plan towards achieving those goals. So now we're going to look at sources of income in retirement and sources and resources that you'll have available. So in terms of sources of income, you'll have your pension, your Social Security benefit, and if needed, we're going to supplement that with savings, either retirement savings from retirement accounts such as a TSP or other employer-sponsored retirement plans from your past, like 401ks, things of that nature, individual retirement accounts, IRAs, retirement annuities, as well as other non-retirement sources, so savings, CDs, brokerage accounts, other types of annuities. Now, a question that I get a lot, and all of us do as planners, is what can I do to make sure that I have a successful retirement? And it really comes down to really two steps. Step one is save early, often, and as much as you can. Step two is invest. Have a disciplined long-term investing strategy. And what I mean by that is have an investment plan, know what you're investing in and why, monitor, stay the course, stick to your strategy, regardless of what happens in the markets. Now, other things to consider when building your plan are what is the strategy behind utilizing all the different resources for retirement? What is your tax management strategy? What will be the most efficient way to leave assets behind for the next generation? Now, if you're not sure, GIBA can certainly help with all these things. So please don't hesitate to reach out for a complimentary consultation. All right, next slide. All right. Now, depending on how you envision retirement and your lifestyle in retirement, that becomes the foundation of the retirement plan because it will drive the need for retirement income. The reason why planning for retirement is important is because we're living longer and we're looking at spending a good amount of time in retirement. Now, on average, women live longer than men, and chances are in a couple, one will outlive the other, and we want to look at security in retirement for both. Outliving your assets is a real and valid concern. Now, back in 1935, when they came out with Social Security benefits, the life expectancy was about 65. Now, the life expectancy for people who are currently age 65 is 86 years old for males and 88 years old for females. So when we plan for retirement, we don't just play for the day after retirement, we plan for 20, 30 years or more into the future. So decisions that we make before retirement will affect our golden years. No doubt about that. So as I was saying, retirement is a period of time, not just a point in time. So we want to take a long-term view. The amount of money that one needs to retire comfortably depends on, when you retire, how much money you need in addition to your pension to have the retirement lifestyle that you want, how long you're going to live, and what your legacy plans are. Now, you want to have a good estimate of your expenses, especially in retirement. And now one way to figure out how much money you need to retire, you want to look at your expenses today, zero in on those that would likely go down, as well as expenses that may go up, such as maybe travel early in retirement and potentially medical costs later on. Now, the sooner you want to retire, the less time you'll spend in the workforce. So the less time you'll have to save for retirement, And that comes with the need to consistently invest for retirement. Now, time is your biggest ally. So when you save as much as you can, as soon as you can, and and as often as you can, and you invest your savings, they will grow over time. Now, the example that we're looking at illustrates the impact that getting an early start, I'm sorry, what the impact of getting an early start can have on your nest egg. So we have the example of Dawn and Dave. The blue bar represents Dawn, who began investing just $2,000 a year, starting at age 25. The purple bar is Dave, who began investing the same amount, but 10 years later at age 35. Now, they both earn the same investment return, but by the time they turn 65, Dawn has 128% more in her account. So due to the power of compounding, consistently staying invested, she ends up with over $300,000 more than Dave. So the lesson here is just how powerful saving, $2,000 a year or just $166 a month can be over a long period of time, and doing it consistently and staying invested. All right. Now, retirement, you got to make sure that you make retirement your priority. You want to save regularly and consistently, because data shows that 98% of retirees regret how they spend their money and wished they would have saved more. You cannot borrow for retirement. Retirement costs, a lot more than education. You'll spend more time in retirement than a child spends in college. So make sure you always pay yourself first, grow your nest egg, and then, you're going to reap the benefits in retirement. Now, another common question that I get all the time is, how much do I need for retirement? Have I saved enough? And it's not a simple answer, because everyone's situation is different. What we do, though, as planners, we run a financial analysis that looks at expenses in retirement, income, resources, and that gives us a pretty good answer for each client. So in terms of how much they would need to save before considering retirement. And this is a crucial part of retirement planning, taking stock of where you are, where you're going, and how you're going to get there. So if you find yourself asking the same questions, please reach out to us. We can always have a one-on-one to understand your situation, your needs, your goals, and help you out. All right, so let's talk a little bit about your retirement benefits. Okay, so the federal employee retirement system, it's basically, think of it as a three-legged stool, where you have your retirement pension, you have your Social Security, and then you also have your Thrift Savings Plan. Now, so this slide kind of shows all these different things, and we'll mail it out, we'll email it out to you if you want to look in detail to each of them. Now, what I want to point out is your pension and Social Security benefits are both fixed benefits. They depend on how much you have worked, how much you have earned, and for how long, and there's not much control that you have over these. Your TSP depends on the amount of money that you put into it, how well you manage your plan. So the TSP will be a variable. Some federal employees, depending on when they retire, so if they are eligible to retire at the minimum retirement age, which is now typically 57, or if they retire at 60, they will qualify for the special retirement supplement, which is meant to replicate the amount of Social Security benefits at age 62. So if you retire at 57, you will get this special supplement until age 62, at which point it stops, and you can either apply for Social Security benefits or wait until a later date, either your full retirement age or age 70 or any age in between. All right. As I mentioned before, you'll be receiving that fixed income from pension and Social Security benefits. Now, supplementing these two sources of income will be your investments and retirement savings. So that's really any money that you've stocked away for retirement purposes, whether in, as we mentioned before, whether in retirement accounts, employer-sponsored retirement accounts, or non-retirement accounts. These are all the different sources and resources that you will have to rely on. So next, we'll take a closer look at the Thrift Savings Plan. All right, so the TSP is going to be the third component of your retirement. It's a defined contribution savings plan, meaning that as the employee, you determine how much you put into the plan and how you want to invest it. For many of you, the TSP will be that nest egg that you want to grow as much as you can before retirement day. Now, remember, this is going to be your cushion for a number of different eventualities, such as emergencies or any other situations in which your pension or Social Security income will not suffice. All right, so here's some of the perks that come with the TSP. So as of October 2020, there's a 5% automatic enrollment for new employees. Contributions are just simply made by payroll deductions. Now, you are going to have a choice between traditional and Roth contributions. So for those high income earners that are not eligible for a Roth IRA account, you will not have access to make Roth contributions through the Roth TSP option. You will have different choices of investment options. There are 5 core choices, so 5 core funds, along with the lifestyle funds. I'll go over those in a little bit. These funds have extremely low expense ratios, and you'll enjoy those automatic and matching contributions. Well, yeah, we'll go over the investment options in the TSP. Okay. Now, how much can you put in the TSP? So for 2025, you can contribute up to $23,500 if you're under age 50. If you're age 50 and up, there's a $7,500 catch-up contribution, so it allows you to add more to the TSP. So your overall contribution limit, if you're age 50 and up, is $31,000. Now, keep in mind the maximum contribution here is a dollar amount. So a lot of people, when I ask them how much they contribute or how much they want to contribute, they'll give me a percentage, like say 15%. Now, but that percentage is really going to be different for everyone depending on your annual salary. So we're going to look at the 2 different types of TSP contributions, the traditional and the Roth. So we'll start with the traditional. These are going to be pre-tax contributions. So if you want to save and take home as much money as possible, allocating to the traditional TSP option could be the way to go. These contributions, they grow tax deferred, and qualified distributions will be taxed at whatever tax bracket you're in at the time of withdrawal. Now, a quick note, all employer matching contributions are deposited into the traditional TSP side, and that is regardless of your contribution type. So whether you make traditional or Roth contributions, the match goes into the traditional side. Now, for the Roth TSP, there are no income requirements, as we see with Roth IRAs, that they limit the ability to contribute to Roth. If you want to, you can put 100% of your contribution into the Roth. And the only, the difference is that it does not lower your taxable income. So you're not going to get a deduction the year that you contribute in. However, the contributions will grow tax-free, and your withdrawals in retirement will be tax-free. That's the big advantage of the Roth type funds. All right. Now, another question that we hear a lot is, what type of contribution is better, Roth or traditional? Now, the answer is it depends. It depends on your current tax bracket, your income level, your income needs now, your income needs in retirement, and your tax rate in retirement. So generally, a Roth TSP might be a good fit if you expect your tax rate to be potentially higher in retirement than it is now, or if you're looking for a tax-free income stream in retirement. At the same time, if you're in a low tax bracket today, you might consider a Roth contribution now, when lowering your gross income will not be a significant tax benefit as it might be later on. Now, on the other hand, a traditional TSP might be a good fit for you if you think you're in a higher tax bracket now compared to when you retire. If you're maybe looking for certain tax credits where your income has to be below certain levels, or you want to take home more money now, so you want a higher take-home pay. Now, finally, there's really no right or wrong answer, since no one knows what a tax rate will be in the future. Diversifying your contributions to both the traditional and the Roth TSP might be a way to hedge your tax bets with your retirement savings. Excuse me. All right, so here's a look at how the TSP matching program works. So if you don't do anything at all, the agency will make an automatic contribution of 1%. Now, this is different than the automatic enrollment of 5% we talked about earlier. That 5% is coming from your pay. Now, besides the automatic 1% employer contribution, you get a dollar for dollar match for up to 3% of your contribution, and then percentages 4 to 5 will be a 50% match. But basically, overall, it comes out to a 5% employer match. All right, so how much should you contribute? So at the very minimum, we strongly recommend that you contribute the 5% to get the employer match. Otherwise, it's free money that you're leaving on the table. Typically, in our planning appointments, we recommend a starting point at 10% if possible, because saving for retirement is important. Now, ideally, you want to get as close as you can to maxing out your contribution. So do the most you can, but no less than 5%. And then when you get raises or step increases, just promise yourself every time that, when you're going to get an increase, you're going to bump up your contribution by 1 or 2%. You can always lower the percentage, but you want to find what the comfort level is. Now, one thing to keep in mind is you don't want to contribute too much too early, because you may lose out on that free match. And we're actually going to see an example of that. So here it is. We have Sean and Susan. They both make $3,400 per pay period. Sean contributes 25%, or $850 per pay period, while Susan contributes $750 per pay period. Now, they both max out their contributions. And the numbers that we're looking at in this table, it's an example that it's actually using 2020 contribution limits. So don't worry about that too much. Now, by the time that Sean reaches pay period 24, he's already maxed out. So he cannot make contributions for pay period 25 and 26, and therefore there's no match for those two pay periods because the agency will only match contributions for those pay periods in which you contribute. So every time he doesn't contribute, the agency isn't going to match. Susan, on the other hand, she contributes every pay period and gets $408 more in employer match. So the point here is make sure you spread your contributions out throughout the year. If you're going to max out the contributions, then make sure you divide the maximum amount by the 26 pay periods to find out what that percentage should be. Okay. All right. So in terms of the importance of the TSP, this example here just illustrates that if you only had the top two legs of the whole retirement system, so the pension and Social Security, you'd be receiving about $65,000 a year in retirement income. But then if you add an additional income stream from the TSP, that will increase it to over $100,000 per year. So, this is the difference between relying just on the pension and Social Security benefits and saving, investing in the right way to make a difference in your retirement income. Right, so we're going to take a quick look at advantages of investing in the traditional side of the TSP, then the Roth side of the TSP. So advantages of investing in the traditional TSP. So the example shows Roger and Regina. They both make $3,400 per pay period. Roger makes pre-tax contributions of $680, while Regina contributes the same amount, but after tax. So we see a difference in federal income taxes that Roger pays. He pays less than Regina, so his take-home pay is $117 more than Regina's. The traditional TSP participant in this example is taxed an average of 18.3%, while a Roth TSP participant is taxed an average of 19.7%. Now, the other side of the coin, so the advantage of the Roth, if we travel 20 years into the future, in our Roger and Regina example, we see that $680 contribution that they've each made has grown to $2,631.39. Now, Roger, who made pre-tax contributions upon withdrawing, will have to pay $386 in taxes when he withdraws, while Regina doesn't pay any tax because her contributions were made with after-tax money to the Roth portion. Now, because of that, her spendable income now is higher than Roger's. So this kind of shows that the difference between the two contribution types. Pay more taxes upfront, no taxes when you take money out, versus take home more money earlier on, but then you pay taxes when you withdraw. If your income tax rate were to stay the same, there would really be no difference between choosing between traditional versus Roth. The tax advantages would not be that noticeable. So if you want to change your contributions between the two types, most agencies have what's called the government retirement benefit system that allows you to make those changes. And you can also go into the TSP website to do that as well and change those percentages. Okay, excuse me. It's a lot of pollen. All right. Now, while you can only make contributions when you're working, you can pool funds into the TSP while working or even retired through a transfer or rollover from traditional IRA, 401k, or other employer-sponsored retirement plans. Now, you can only transfer taxable dollars into a TSP. It does not allow you to bring in Roth money. And if you were to take money out of the TSP, you will have to maintain a $200 balance in order to continue contributing. All right. The TSP does allow for loans. The minimum loan amount is $1,000. The maximum amount is $50,000 of the vested balance, or $10,000, whichever is greater. It does carry a low interest rate, and you're technically paying yourself back. So in that sense, it's a better option than getting. Oh, sorry. Let's go back for a moment. Okay. So in that sense, a better option than getting a bank loan, simply because interest rate, again, it's low, and you are paying yourself, and repayments take place through payroll deductions. You can set it up that way. All right, so real quick, direct and indirect rollovers. So this could apply to transferring into the TSP or out of the TSP. If you're 59 and a half, or I'm sorry, you're over 59 and a half and still working, you can transfer out of the TSP as an in-service rollover. Same if you separate from employment, whether you retire or just get a different job. Now, a direct rollover is a transfer between firms, so between the TSP and your new custodian. An indirect rollover is where the distributing plan makes payment to the participant. So basically, you receive a check in the mail, and then you have a 60-day rollover period in which to deposit it into a retirement account. So again, you can roll over a traditional IRA into your TSP, but you cannot transfer or roll over a Roth IRA into the TSP. And all rollover requests are done through the TSP online portal. All right, so TSP investment options. We're going to take a look at this real quick. Now, you can choose different options, as I mentioned earlier, to invest your funds and put them to work for you. So you have the 5 individual funds, the GFCSI, the L funds, which are different combinations of the 5 individual funds, as well as access to other mutual funds that the TSP has made available since 2022. Now, access to those type of investment come with some conditions, as well as transaction fees, which can make them expensive, and we'll go over them. Now, the pyramid here, what it's meant to show is the risk-return relationship. The riskier an asset is considered, the higher the return that it can bring you. Now, past performance is no guarantee of future results. We must always remember that while we go through all the different investment options, because we're going to look at some of the returns. So let's move on. So when investing, there are a number of things that you want to consider. So one of them is risk tolerance, meaning your level of comfort with the ups and downs of the investment, and how well you're able to sleep at night when the markets are down. Time horizon is very important in the sense that so that's really the time of the time period that you can be invested for before you need to access the funds. So generally speaking, an account with a short time horizon or a short term goal should not be too aggressive. Now, a question I hear a lot is, how should I be invested? The investment strategy is a crucial part of any retirement plan, and is different more or less for each individual. Now, we will talk in a little bit about investment allocation, and try to get some pointers. But at the end of the day, if you're not sure, how you should be invested, uh, I'm going to say this again, please don't hesitate to reach out and speak with an advisor, whether it's, us here at GIBA or your own advisor. So an advisor that can review your plan and may be able to make recommendations based on your individual financial and personal goals. All right, so let's take a look at risk. Okay, so there's a risk return trade-off, meaning the higher the risk an investment has, the greater the potential for return. But at the same time, the higher the risk, the higher the bigger the downside risk as well. So in order to reduce your overall volatility, you would do that by diversifying away risk, and we'll actually kind of look at that in the next portion when we talk about asset allocation. So there is little to no market risk in the G fund, but you have a different kind of risk, which is that the investment will not grow enough to offset inflation or meet your financial retirement needs. So basically, you always want to look at the trade-off. So don't be too conservative and hamstring yourself by not allowing your accounts to grow enough. Just kind of find that Goldilocks spot where it's not too risky, it's not too conservative, you're comfortable with it, and it also provides enough growth to meet your needs. So asset allocation is how you control the degree of risk within the account. It's a mix of cash, stocks, and bonds, also referred to as asset classes. So it's the mix. The mix that you'll allocate to your overall portfolio. You'll allocate your overall portfolio into. Now, historically speaking, stocks carry the highest potential of growth and the highest degree of risk. Um, and really, there's simply no perfect asset mix or asset allocation. As financial advisors, we develop the mix as part of the investment strategy individually for each one of our members based on their specific financial and individual circumstances as part of their financial plan. Now, once you came up with your ideal mix or allocation, it does need to be monitored over time and adjustments made as needed to stay within your risk comfort zone. What do I mean by this? So when you look at the pie chart, the assets are split roughly 33% in each of the three asset classes. Now, let's assume the market has a really good year and the stocks see a 20% increase in value. Now, at this point, the stocks will take up more than that 33% that we've set off with. So that increases the overall risk in the portfolio, and you'll want to adjust those percentages and bring them back into alignment with your risk tolerance. Now, stocks, bonds, CDs, money market, etc., they all have different risk factors and very different reward potential. Balancing these investments adds tremendous value to the portfolio and decreases the exposure to risk because it not only diversifies away risk, but also helps you get a little bit of everything that's out there investment-wise. All right, so 1 second. All right, so the next thing that we're going to do is quickly go through the G funds. So for those that are maybe not super familiar with them, it's a good opportunity to understand a little bit about them. So the G fund, this one invests in non-marketable treasury security issued specifically for the TSP by the US government. So this fund is the only one in the TSP that guarantees the return of the investor's principal. It has the lowest risk of the five funds. Now, the G fund has historically provided the lowest rate of return of any of the core funds, but it's also, as I was mentioning, the safest. Now, next up is the F fund that's meant to be a bond fund. It invests in a wide range of debt instruments, publicly traded treasuries, government agency securities, corporate, foreign bonds, and its return has been, historically speaking, when we look at, I'm having technical difficulties, as you can tell. So when we look at the average return over a long period of time, a little better than the G fund, and with that comes a little, it's a little riskier, but its underlying securities can vary in value, so you may see some up and down with that one. All right, the C fund. Now, this one is the most conservative of the 3 stock funds available in the TSP. It invests in the 500 large and mid-cap companies that make up, so it's basically mirroring the S&P 500 index. The next one up is the S fund. So this is a small cap fund. Is considered one of the 2 funds with the greatest risk in the TSP. All right. Then we have the international fund. So this one is one of the broader international indexes, or mirrors, okay, one of the broader international indexes that invests in larger, more established companies located in 22 developed countries around the world. It is regarded as the other high-risk fund in the TSP, and it's the only fund in the TSP that invests in companies outside of the US. Now, because of its exposure to currency risk, this fund will rise or fall as the value of the US dollar decreases or increases relative to the value of the currencies of the countries represented in the index. So you have not only performance risk, but also currency risk. All right. Now, the L funds, they are designed and managed by the portfolio managers at BlackRock Capital, and they basically function as an automatic pilot fund for participants who don't wish to make their own asset allocation, and they can just grab one that's already been put together by a portfolio manager. If you choose to go with one of these, the lifestyle funds, take care to match the maturity date of the L fund with the time that you're planning to begin receiving distributions, as they do become more automatically more and more conservative as you approach that target date that's listed on the fund. All right. So this is the newest option that the TSP had introduced, which is the mutual fund window. So it was introduced in June 2022 as an option for participants who wanted greater flexibility or more options than just the core 5 funds and the NDL funds. They are subject to fees and certain limitations and requirements. So the fees, it's a first you have a $55 annual administrative fee, a $95 annual maintenance fee, and then there's a pay trade per trade fee. and there might be other fees and expenses specific to the mutual funds that you choose. And here we have the requirements. So the initial transfer to the mutual fund window must be $10,000 or more, but not more than 25% of your total TSP savings. And they also require that you have at least 40,000 in your TSP account to ensure that your initial transfer isn't more than that 25% minimum. And you may not invest more than 25% of your total account balance in the mutual fund window at any time. All right. Now, when it comes to managing your TSP account, so beyond the allocation, monitoring the investments, making adjustments if needed, or if you're not in an L fund, other aspects to consider or look at are reviewing your contributions, so making sure they're not too high, not too low. Make sure that you make changes, especially, and when we say make changes, is pertaining to contributions, so whether traditional or Roth, or percentage-wise. And lastly, the beneficiaries. Okay, and I'm sorry, I'm going to kind of try to go faster at this point because we're coming up on time. So an important aspect are the beneficiaries. If you do not have a designated beneficiary on file with a TSP, your money will be distributed according to the Thrift Savings Plan document. It first goes to your spouse. If no spouse, then to your child or children equally, then to the descendants of your children. If none, then your parents. If none, then your appointed executor or administrator of your estate. If none, then to your next of kin. So keep in mind, it will not honor a will. The easiest thing for everyone is to designate beneficiaries, have designated beneficiaries on the TSP account. All right, so let's move on to just markets. We've all seen how volatile the markets have been recently. A lot of the volatility has to do on one hand with sector rotation that we've seen happen in January. It's kind of, historically speaking, we've seen it happen where the big investment firms will try to realize some of the gains or take some money off the table in those sectors, such as IT, as an example, technology. So realize some of the gains and reallocate to other sectors they believe will do well or are less overbought. It also has to do with different things that the administration is talking about. Chief amongst are the tariffs. I know that they were saying that we'll get further, more clarification today, April 2nd. Now, we haven't really seen anything concrete to this point. There are promises that by tonight or by tomorrow. Now, most of the portfolio managers and investment analysts expect for market volatility to kind of settle down once we have some guidance and clarity in terms of what the tariffs are, because the one thing that drives the markets off a cliff or drives them crazy is really uncertainty and lack of guidance, where no one knows what's coming down the pipe and how to prepare. All right, so I want to take a moment and kind of read this with you. So one of the most successful investors of all time is Warren Buffett. In his words, to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. So what he's simply saying is, have an investment plan, implement the plan, stick with the plan over the long term. Do not let emotions derail that plan. So whatever you're hearing in the media or on TV, the market is crashing. Do not let that fear undermine your long-term goals. We've seen very smart people make very bad mistakes simply because they let their emotions get the best of them. So, you know, I cannot stress this enough, and we're kind of going to see through the next slides on market performance a few of these things. Just, you know, if you're invested for the long term, trust term, as long as you're doing all the right things, which is monitoring, making adjustments, trust the process, and stay invested. So what we have here are asset class returns over a 10-year period, and that just goes hand in hand with that pyramid that we looked at earlier. It basically shows that growth stocks, which are in terms of risk one of the riskier ones, are also the ones that have yielded the highest return. I apologize, one second. All right. So high risk, high return. On the other hand, we'll see that when the market went down, they went down as well. Now, some of the bigger market drivers over the last five years have been the big tech or magnificent Seven, as you may have heard. So the blue line is represented by the group of these 7 big tech companies versus the performance of the other indices in the market. But again, what's important is stay the course. Don't give into panic or fear and exit the market. You know, market has ups, market has downs, but over the long term, the trend has always been upwards. Now, what this slide shows us is, you know, someone that went through the different market declines and just held on and went through market recovery and all of that versus someone that went through the same market declines. However, they moved their assets to cash for a year and then re-entered the market, and we can see it's a significant difference. And also, I mean, not even going to talk about the yellow line, which is someone that just moved to cash and stayed in cash versus someone that held on for the long term. All right, again, I apologize. The pollen is just killing me. So historically speaking, what we've seen and what we've known to be the secret of success is establishing, implementing, and maintaining that disciplined investment strategy. So once you put together your mix of investments, the right mix for you from a risk return perspective, just stick with it for the long term. Make changes as needed as things change in your personal circumstances, whether it's, you know, marriage, the birth of a child, kids maybe starting planning for college or wedding, nearing retirement. So unless we deal with those type of events, then there's no need to mess around with them too much, except for making sure your investment mix, your asset allocation stays within your risk tolerance levels, your risk comfort zone. Okay. So this chart here, oops, let's go back. So the chart, this one again shows us, yes, we know market goes up, market goes down. So these are some of the biggest crashes that we've seen. The worst one was the March 2000, the .com bubble, the tech crash. But when we look at it, we see that even if in the short term or sometimes even short to medium term, things didn't look that great. In the long term, but the blue line is after 5 years, after a crash happened, we see that line being, way higher than where it started. Okay. Now this chart shows us more or less the same thing. So over over a 15-year time period, the 1-year return was negative 27% of the time, and positive 73% of the time. But when we average that out over a 5-year period, it's negative only 13% of the time, the return. And if we actually average it out over the entire 15-year period, it's actually positive. So staying invested, staying in the market, it's way better than trying to time the market, because you just don't know when the market is going to rebound, and you may miss on some of the best days, rebound days. So this one here, it speaks to the importance of a diversified portfolio. So these are all different asset classes, and it basically shows, hey, if you're out there and you're holding a little bit of everything, some years, some of them will do better, some will do worse. At the end of the day, you're diversified, you have a little bit of everything. So you'll benefit from opportunities in different areas, whether that's that has to do with geographic location, or small versus medium versus large cap, growth versus value, and so on. Okay, and I'm sorry, I'm kind of rushing a little bit because I know we're coming up on time. All right, so human behavior, emotions play a really big role in investing. People feel the pain of loss much deeper than the pleasure of an equivalent gain. So it's really important just to understand normal market behavior. Know that yes, markets go up, markets go down. Any year there's the real possibility of seeing a 10% correction, but that is normal market behavior. So, don't let fear get the better of you. Just, always frame your investment. When you think about your investments, frame it in, hey, what is the big purpose? Where am I going? Why am I investing? So just stay focused on the long-term objectives. Okay. All right. So what should you do to your portfolios? Well, we talked about first of all setting up the right mix of different types of assets. So have that plan, stick to the plan, make changes only when needed, and not driven by market movements. The market will do what the market will do. You just stay focused and invested. And if you need to get a second opinion or double check, you can always reach out to a professional advisor, again, either here at GIBA or your own advisor. So we got to that section that was recently added in, just to kind of talk about the workforce reduction happening across the federal government. So we've all heard about the deferred resignation offer, an effort to downsize the federal government. It did require a decision by, well, they said February 6th, but some agencies are now reoffering the deferred resignation, where you would be placed on administrative leave, receive pay and benefits till September 30th. We did get a lot of questions about, hey, should I take it? What should I do? The answer is really, it depends. It depends on what makes sense for each one of you in terms of the long-term goals, whether that's retirement or whatever other financial goals you may have. So if you are being offered the deferred resignation and you're not sure what to do, reach out to us and we can help you reach a decision. Now, other workforce reductions, so there's the voluntary, the VERA reduction in force. Now, the reduction in force can be, depending on age and time in the government, could be an opportunity for retirement or not. So so generally speaking, these are general eligibility considerations for pension. So there are three eligibility steps, right? Minimum retirement age with 30 years of service, age 60 with 20 years of service, or age 62 with 5 years of service. If you're under age 62, if you opt for an immediate annuity, so to start taking pension right away, you may get a 5% reduction in benefit. Now, this does not apply with VERA, because if you are offered VERA, the benefit of VERA is one of the main benefits is no reduction in annuity for retirement age below 55. So that is a definite benefit. And again, we'll send all of these out. So then we have postponed retirement versus deferred retirement. So postponed is someone that is meeting the eligibility criteria but wants to delay receiving pension benefits in order to avoid that age reduction penalty of 5% per year. Whereas deferred retirement is someone that is not eligible for full pension, so would leave service before the minimum retirement age, but has at least 5 years of credible service, and they can choose to take their pension at age 62. The biggest differences, and we have this handy chart. So the biggest differences are when it comes to the health and life insurance benefits. Deferred is not eligible. Postponed is eligible. Okay, pension reduction, none. Okay, all right. So, oh, sorry. So those were the biggest two differences. And again, you'll get all of this to compare. And I apologize for running over. You'll get all of this, and remember, you will have a survey. So if I missed addressing any questions, which I probably did, you're more than welcome to ask us those questions, and we will definitely get back to you. So this is all the different services and benefits that GIBA provides, and here's our contact information. But again, we're more than happy to reach out and help. It's what we do. So let us know if you need us, and we're more than happy to assist. Thank you so much for your time. And again, I'm sorry I took up more than expected, but I hope that you found this information useful and will help you with your retirement planning. Thank you so much, and hope you all have a great day.